what are some of the things that vol managers think about? So again, we talked about not necessarily really expecting or seeing like a big sudden market crash with a big vol event, because you don't have the catalyst in place for that. You don't have the market structure in place for that. You don't have the positioning in place for that. Things that we think about, in 2022, actually being short delta versus short vol worked out really well, right? So on a market neutral basis, you get that kind of grind down, vol's underperforming, the short delta works really, really well. That's one trade that's performed really well. You can think about different kinds of option structures, like longer term downside put flies, right? Things where you're not betting on that big crash. The big crash isn't going to work out. You're spending a little bit of premium, but doing really well if you get that 10% grind down or that 15% grind down. A lot of those kind of trades can work out really well in that path. Yeah, just getting out there and, buying a whole bunch of Vega, may really not.
Yeah.
The other thing and you alluded to this, but, there's so much supply of short dated options in the world, all the call overwriting, all the cash secured put selling out of big institutions and everything, that inevitably that gamma in the front of the curve stays kind of cheap. And, folks like us usually end up staying long that. And then you think about this environment with, tweet driven policy or, reversing with the market down, market up, new tweet, market gaps up 2% in the futures and then sells off the next day. Owning that gamma is really nice because you can just scalp that sort of P&L from market movement.
Right. Because at the end of the day, if you are more likely to get those declines, and they are actually more likely to even be bigger because the hedges aren't working, right? You're going to get the realized move. And again, it may not be as fast, but you're going to get some type of meaningful decline likely in those scenarios. The key is, managing the implied vol part, which can be a little hard. And when interest rates go higher, I can't emphasize this enough. As interest rates go higher, you get to now stack a return on top of a T-bill yield, which is going higher. That dynamic, which isn't very well understood, is what's driving the structural product boom, by the way. People don't really understand this. Because if you could get, let's say, a 3% yield on or 4% yield on something, but you were getting 0% underneath the hood on the risk-free rate, it wasn't competitive.
Mm-hmm.
But guess what? When you get to a 4.5%, risk-free yield and you stack, let's say 4.5, all of a sudden it's very compelling in a non-correlated way with way less risk. Why would you be in equities, given the risks when you could do that? And so I think that story is very compelling. And I think a reason why I think everybody needs to be looking more non-correlated.